Welcome to The Explainer. Okay, today we're cutting right through all that daily financial noise to re-examine the actual core engines of wealth creation. We hear these terms thrown around constantly by analysts and financial commentators, but today we're stripping away the static. We're going to look clearly and directly at the structural mechanics of stocks, mutual funds, and debentures. Let's get into it.
Okay, let's dive into this. Here's our roadmap for today. We'll start with the $10,000 dilemma, then we'll walk through Path 1, company ownership, Path 2, professional management, and Path 3, becoming a lender. After that, we're going to stack them up by comparing risk and return, and finally wrap things up with your wealth-building playbook.
Section 1, the $10,000 dilemma.
All right, to really grasp these concepts, we need to take them out of that abstract financial world and bring them right into your living room. Seriously, I want you to imagine right now that someone hands you exactly $10,000 in cash today. What would you do with it? It's a serious question because, even seasoned investors sometimes rush to allocate their capital before truly assessing the structural advantages of what they're actually buying. We often overlook the fundamental mechanics of, say, a debenture in favor of flashy stocks simply because of all the market hype. But listen, that $10,000 sitting right there in your hands gives you three very distinct choices. You can invest in stocks, you can invest in mutual funds, or you can invest in debentures. And honestly, the path you choose right here, that's exactly what is going to shape your financial future.
Section 2, Path 1, company ownership.
So, let's look at how this mechanism actually works out there in the real world. Imagine a major tech conglomerate wants to raise capital to, acquire a competitor or maybe fund some massive new research initiative. Well, instead of taking on debt from a syndicate of banks, the company decides to issue equity. They slice the company's equity up into millions of tiny little pieces, and each of those units is a share. So when you take your hard-earned money and buy a share, you aren't just buying some random ticker symbol blinking on a screen. You literally acquire a proportional claim on their future cash flows. You become a part owner of that business. If the business scales up and succeeds, the value of your investment grows right alongside it and often compounds through dividends. It's pretty powerful stuff.
Now, what's really interesting about this is the intense duality here. On the left side, the pros are absolutely massive. Stocks offer incredibly high long-term wealth creation potential, absolute liquidity, and the true benefit of exponential business growth. But look over to the right side at the cons. Prices can fluctuate wildly based on macroeconomic trends. Choosing this path requires intense research and, honestly, more importantly, ironclad discipline. Making emotional decisions here can lead to heavy, heavy losses. But what if you just don't want to spend your weekends poring over quarterly earnings reports?
Section 3, Path 2, professional management.
Imagine you simply don't know which individual equities to pick with your 10 grand, or maybe you just prefer a more hands-off approach. Totally fair. Instead of guessing, you hand your capital over to a professional fund manager. This manager takes your money, pools it together with capital from thousands of other investors, and buys a highly diversified portfolio across a bunch of different sectors and companies. That pooled, diversified portfolio is the primary value proposition of a mutual fund. You see, you don't own the individual stocks directly. Instead, you own units of the mutual fund itself.
The trade-off here is pretty clear-cut. You gain instant diversification and professional oversight, which, let's face it, is incredibly convenient if you want broad market exposure without the daily hassle. However, on the flip side, you kind of forfeit control. The value of your fund still moves up and down with the broader market, so you definitely aren't immune to systemic risks. Plus, and this is a big one, you guarantee management fees to that professional running the fund, and they get paid regardless of whether the fund actually outperforms or underperforms the market.
Section 4, Path 3, becoming a lender.
Now let's pivot to a completely different approach. What happens if a company wants your capital, but they absolutely refuse to give up any ownership of their business? And this brilliantly illustrates the fundamental divide in investing. On one hand, you have stocks, where a company raises capital by selling equity. On the other hand, you have debentures, where a company raises capital by simply borrowing money. You are no longer an owner taking on the operational risks of the business. Nope, you are stepping directly into the shoes of the bank. A debenture is exactly that. It's money lent by an investor to a company. In exchange for your $10,000, the corporation generally promises to pay you a set, predictable amount of interest over a specific period of time, and then repay your principal amount when the debenture reaches maturity. So if you choose this path, you really have to remember your role. You are strictly a lender, not an owner. The pros of debentures appeal to a very specific strategic mindset. You secure a much more predictable income stream with generally way lower volatility than equities. And crucially, listen to this. If the company goes bankrupt and is liquidated, you as a lender have absolute priority over the shareholders to get your money back. That is a massive structural advantage. But the cons? Well, your growth potential is significantly capped compared to successful stocks. You also face interest rate risks and the ever-present credit risk. That's the chance that the company defaults and simply can't pay you back. So this path is really for those who prioritize stability and capital preservation over maximum growth.
Section 5. Comparing risk and return. So we have our 3 distinct paths. How do we make sense of them side by side? Well, when we stack these up, notice how higher potential returns are inextricably linked with higher risk. It's just a fact of life. Stocks offer high growth potential and possible dividend income, perfectly suited for the aggressive long-term investor. Contrast that with mutual funds, which offer moderate risk depending on the portfolio, yielding moderate to high growth for those wanting diversified exposure. Finally, look at debentures. Lower risk, capped growth, and fixed interest, built specifically for the income-focused investor. The absolute golden rule here is that there is simply no such thing as an investment with high returns and zero risk. It just doesn't exist.
Section 6, your wealth building playbook.
Now that you understand the mechanics, a very logical question arises. Do you really have to choose just one? Like, can you invest your money in all 3? Absolutely. Let's see how this builds out. Many experienced investors build a diversified portfolio that balances these exact vehicles. Notice how an allocation might carve out a portion in stocks for aggressive, long-term growth. Then they allocate a portion to mutual funds for broad diversification. And finally, they secure a portion in fixed income investments, like debentures, to provide portfolio balance and reliable yield. Of course, the exact mix you use will shift entirely based on your unique goals, your time horizon, and your risk tolerance.
But before you deploy a single dollar of that $10,000, you need to lock in these 5 golden rules. Number 1, know your financial goals. Are you building a down payment or are you funding a retirement? Number 2, understand your exact risk tolerance. Like, honestly, can you confidently stomach a 20% market drop? Number 3, diversify instead of relying on a single asset class. Number 4, invest for the long term to let compounding do the heavy lifting for you. And number 5, keep learning. Markets evolve, and so should your strategy. These 5 steps are your ultimate defense against emotional and blind investing.
And that leads us to the ultimate realization. The smartest investors out there, the ones who actually build and sustain generational wealth, they do not ask which investment is best. They know that's the wrong question entirely. Instead, they ask, which investment is best for my goals? That subtle shift is the entire difference between true calculated investing and simply chasing blind returns. So as we wrap up this explainer, I'm going to leave you with that exact question to reflect on for your own financial journey. Thank you so much for joining me to explore the trio of wealth. Take these tools, evaluate your own goals, and go make your money work for you.